Nitish, speaking of capturing market share as well as focusing on unit economics, we are once again faced with challenging times. The environment has changed. The era of easy money, of abundant capital, perhaps is looking tighter at this point in time, given the global environment and the change that we are seeing as far as interest rates are concerned. And I was just reading a blog, that said that the era of revenue multiples is perhaps over, at least for now. So Nitish, you were talking about your own experience of dealing with the dot-com bust and how that forced you to look at building a sustainable, profitable business. And now you've, of course, gone on to IPO as well in 2021. But as you see the environment today, what do you believe the need of the hour is in terms of changing the way that people are operating? What worries you and what gives you confidence in what you're seeing today?
Sure, Shireen. So I think for me, the opportunity on startups, right, and the opportunity that our own market offers today is unparalleled. Like I was telling you earlier, I have no doubt that in the next few years, India is going to become the startup nation of the world. And these market cycles, as we are experiencing right now, will keep happening. They've happened, many times in the past, and it's a stopgap, a cycle which will happen for 6 months, 1 year, 2 years, and then you resume. I think India's on a one-way trajectory of value creation that's never been seen before. And as Sanjeev was saying, the kind of hunger that the entrepreneurs have and the accelerated maturity they have, plus the market size they can play in now, is almost a perfect storm for India. So I think the founders and the startups should not lose plot of the bigger picture. They need to focus on the bigger picture. But in the interim period, if the cycle is bad, if raising funds is going to be difficult, they have to do whatever they need to do to survive. Because as long as you can live to fight another day, you can win the war or win the battle, right?
Don't lose out on the big picture, don't lose out on the big opportunity. But let's talk about the metrics that one should focus on. And Sanjeev Agarwal, to Nitish's point there, that look, as far as the good companies are concerned, the money will continue to come in. It's perhaps not going to be as quick or as easy as it was over the last few years, but the money will come. But on finding this balance between not being too risk averse or too conservative and not being hyper growth at any cost, what should the metrics be that entrepreneurs today should focus on?
I think, Shireen, the top two that come to my mind, one would be gross margin, because that tells you whether your value proposition is being compensated for by the customer. And the second one which comes to my mind is customer experience as measured by Net Promoter Score. I think any company which can establish these two fundamental metrics, that customers love the product and hence their cost of customer acquisition will come down, and they have strong gross margin, which will then flow into the profitability of the company, I think you are in a good shape.
Right. Nitish, one of the other aspects I want to understand, and especially from your own experience of IPOing, and this takes me back to a conversation that I had with Mr. Murthy just a few days ago, where he said that what we are now starting to see happen much more of is that founders are looking at IPOs merely as a financing event and nothing more than that. But in fact, it changes the ball game altogether. So I want to understand from your own experience of IPOing, what you would like to put on the table in terms of lessons learned, more importantly.
Sure. I think, for us as a company that had been around for, nearly 2 decades, I think it was the right time to IPO. We had been profitable for many years. We had our business fairly stable and growing well. And so we were confident. We had a governance right. I think that was very important. We had, the basic structures in place, the basic teams in place. So for us, the IPO was a natural progression, to grow up, I would say. And I don't think the IPO can be looked upon as just a financing round, because it comes with a lot more responsibility. Today, Nazara has over, 150,000 shareholders. And, everything we do has to be keeping them in mind, right? And keeping their interests in mind. So I think you have to have the right balance. Of course, you can't, as a company, start only playing to the gallery. You have to take your strategic long-term decisions. We are trying very hard to ensure that we are not taking decisions only to meet quarterly targets of what the market expects us to do, but be brave enough to also take decisions that may be medium to long term. But I think going public only from a financing perspective is completely the wrong way to do it.
Sanjeev, I want you to comment on that. Through your experience of seeing the IPOs of the likes of Make My Trip and many others that you've been involved with, what should the IPO playbook be for those who are waiting in the wings now, looking at that possibility and that option?
Probably one would be that there is 30-40% growth rate, because markets like to put money behind growing companies. So you need not be growing at 100%, 200%. 30-40% growth rate looks good. Two, I think you should have a path to profitability so that you don't have to raise capital again while maintaining 30 to 40% growth rate. And three, I think you should have good systems in place in the company so that your performance is very repeatable and is not very volatile. And I think fourth, probably, you have to also pay attention to the industry structure. If you are part of an industry which is hyper competitive and you have to respond to that competition, then you probably want to wait a while before you go public. Because in a hyper competitive industry, I think doing both the things simultaneously, which is growing market share and generating profitable growth, can be a hard one to prioritize.
But Nitish, speaking of market opportunities, and as you mentioned, you firmly believe that it is a one-way trajectory as far as the Indian startup ecosystem is concerned. It's only going to get bigger and better from here. But at least as far as the new areas of opportunity are concerned, one is hearing anecdotal stories about Indian startup founders relocating, especially in the Web3 space, because of the regulatory challenges and the regulatory uncertainties. How much of a real move, a real shift, a real transition is that? And where do you believe the next wave of opportunity is going to lie as far as this story is concerned here in India?
Sure. So if you see, I see a lot of startup founders now, especially in, areas like Web3, blockchain, which are moving to, places like Singapore and Dubai, to friendlier regimes or where there's more clarity in terms of, what is possible to be done. So yeah, I am seeing that kind of migration, but at the same time, the number of founders and startups I'm seeing, in India itself is no less. I think while a small percentage for their own reasons may move out, I think there's a very, very large movement that is happening in India. And which is why I firmly believe that India is going to become the startup nation of the world. That's a one-way trajectory I was talking about. So I have no doubt about it. And I would not be so worried about some founders moving abroad. Of course, if we can retain, they are great talent, great opportunities. If we can manage to retain them, nothing like it. But nevertheless, I think the whole startup ecosystem in India is only going to scale and at a much faster rate.
Sanjeev, how excited are you about the Web3 opportunity in India? What are you hearing in terms of migration, especially from the Web3 space, of founders moving out of India? And more importantly, the last big shakeout that we saw in the Indian startup ecosystem was around 2015. We saw many closures. We saw a fair amount of consolidation. Are we likely to see that play itself out, at least in some of the key sectors that we saw a lot of the money coming in, EdTech, for instance? Is that right now for some even more serious consolidation and shakeout?
Shireen, this time the big difference is that the startup activity is actually quite widespread. So in early 2000, startups were confined to travel and retail, Make My Trip and Flipkart. But now they have transcended to all industries and sectors. And I still feel that we are very early in the digital penetration of these industries. So my sense is that companies which are well run, which have good unit economics at a transaction level, which have good customer experience, will find new capital for themselves. I think the trouble would be companies which have really not created any strong value proposition and have very high cost of acquiring a customer. And as I said, value proposition is little feeble. Those are the companies which will not be able to get new capital. But given the low penetration rate, I think there is a lot of growth ahead of these startups.
Nitish and Sanjeev, it's always a pleasure speaking with the two of you. Thanks so much for joining us here to recap the story of the past 2 decades, but more importantly, also look out for what lies ahead for India's startup ecosystem. We wish both of you the very best of luck, and we look forward to having you over the next 20 years, hopefully, here on Young Turks as well. Thanks so much for your time today.
Thank you, Shireen.
Thank you, Shireen, and you must take equity position in all the companies that you cover. You'll be a very, very rich person.
I wish I'd done that. I wish I'd done that with Nitish, considering the fact that he found his match here on Young Turks.